Hi everybody, it's Martin Wildy from the investment team. I'm joined by my colleague Geoff Caber, and we are here to give you an update, the July market and economic update. So we're going to start with a overview of how markets are doing so far this year. We have the chart up here that shows you different parts of the market and how returns have been over different periods, prior years, and including year-to-date 2026. So real quick, we'll just highlight that it has been a very strong start to 2026. So the first 6 months, we saw the S&P 500 index up over 10%. And I will say that dividend-paying stocks also doing well this year, small cap stocks having a very strong year, up over 20%. And then international markets are also having a good year. So across equities, seeing a lot of positive performance. Within fixed income, we're also seeing positive returns, a little bit more muted, but we are seeing fairly healthy returns so far out of corporate high yield bonds and municipal bonds, and the aggregate bond index is positive by a little bit. And then we have seen some volatility in different parts of the commodity and cryptocurrency market. You can see Bitcoin continues to sell off, is down about 33% this year. Gold and silver also negative, but commodities overall are in positive territory. One of the reasons for the strong performance in commodities is really related to what's been going on with energy prices this year. So energy prices have run up a lot. They ran up a lot earlier this year based on the closing of the Strait of Hormuz. And you can see that in the green line with crude oil prices. But notice how over the last month we've seen a real drop in oil prices, which has really been welcomed by markets. The other thing you'll notice in the top part of this graph is it shows the volume of containers going through the Strait of Hormuz, and notice how it dropped down to almost no activity. And very recently we've started to see that pick up again, which is very encouraging for us to see. So hopefully as we see more traffic, we'll start to see energy prices continue to move lower and provide some relief to consumers, because we can see that gasoline prices, while they have come down off their highs, which is a good sign and should help the economy, we're still meaningfully higher on a national average than we were before the conflict started. So still a lot of work to do with energy prices coming down. And then I will say the other big driver of the economy has been AI spending. We all hear about AI and have used AI, but there's a tremendous amount of capital spending that's going into building out these data centers. So that's amazingly a larger contribution to economic growth right now than other contributors to the economy. So we have seen tremendous growth from the technology companies and how they're spending to support AI. So with that, I'm going to turn it over to Geoff, who's going to talk about what we see with corporate earnings and some other economic indicators.
Sure, thanks, Martin. And yeah, just you're just talking about the economy continuing to do well, and corporations are benefiting from that. And if you take a look at this chart, this shows the aggregate corporate earnings for the S&P 500 over the last decade. And on the right-hand side of the chart, you can see the increase in corporate earnings that we're continuing to see. And so just by way of example, we just finished the second quarter, and we're expecting year-over-year earnings growth for the S&P 500 companies of over 20%. We had the same thing the beginning of the year in the first quarter 2026. Earnings growth were over 20% versus 2025. So definitely companies are benefiting from the efficiencies from AI and the economic growth. Now, on the other side, talk a little bit about inflation, and Martin, you were mentioning energy prices, and that really shows up in this chart. And energy, this chart is the green section, and this is the CPI, or Consumer Price Index, since 2018. And one thing I just want to point out, you can see just right after the pandemic, energy prices were negative. Economy wasn't using a lot of energy, then shot up coming out of the pandemic. One of the reasons why supply chain disruptions, then also the war with Ukraine and Russia. But inflation did come back down, but now we're starting to see the inflation tick up more recently due to the higher energy prices. So with the Strait of Hormuz opening up, we're hoping to see that CPI number start to decline in the second half of the year. One of the big drivers of the Fed's decision on interest rates is inflation, so we think that has a big part to do with their discussions. And then finally, I want to take a look at our dials. And once again, this is how we kind of project how we feel the pace of these different areas are in the economy. We're seeing growth in employment still moving along at a good pace, but we do have households as a negative. Once again, consumer sentiment, inflation is still there. We're seeing that real wages haven't been keeping up with inflation, so consumer sentiment remains negative, so we're keeping that as a negative also. Moving on to financial conditions, that gets back to the inflation and interest rates. We think that we are moving into a period where the Federal Reserve, for monetary policy, went from potentially lowering interest rates coming into the year to potentially increasing interest rates later this year. So we have a negative there, and we already talked about the inflation and how that is still a risk at this point. And then finally, credit spreads, that kind of looks at the difference in interest rates between corporate bonds and US Treasuries. They're still very tight, so that's a positive. And then finally on the market, we talked about valuations where oftentimes we're seeing the S&P 500, the larger companies, technology maybe being a little overvalued based upon historic measures. But in general, across the board, we are seeing areas like dividend paying stocks, international stocks, and small company stocks that have reasonable valuations. And then finally, as I mentioned, corporate earnings are positive, and the trend is positive as we've been seeing some good solid returns in the market. Martin, I'm going to send it back to you.
Great, thanks, Geoff. So I know that was a quick flyby of what we're seeing in the markets and economy this year. There's a lot of stuff that we're monitoring very closely. Thanks for your time and attention today. If you have any questions on anything that we covered, or if there are other things that we didn't cover today that you have questions on, please don't hesitate to reach out, and we'll be back in touch. So thanks so much, and have a wonderful rest of your day. Bye now.
Thank you.